What's up, everybody? Welcome to you to this July 2024 market update. We're going to take a look at some content that's a little bit different if you've been joining us quarter over quarter. I'm Dan Beer, by the way, Beer Home Team here at eXp Realty. Been recognized by Wall Street Journal among the top 40 teams in the nation, 2021 San Diego Business Journal top team in the county. On and on, right? Inc. 5000 4 times. Look, the only reason I mentioned that is the content I'm going to bring you, the analysis, the understanding of it, and also the interpretation of it comes from a place of a lot of experience, over $3 billion of just local transactions. And I'm going to share with you exactly where the market is right now, what's happening with inventory, where is the rate environment, and also just some really interesting data as far as how we compare locally versus national statistics that people like to lean on. Sometimes you're only ever getting that national statistic. And so we'll see how that actually shows up or how we compare on a local level. So I'm going to take a deep dive into the current market environment. By the way, if you at any point want to ask a question or have a comment or need a follow-up, you can go to the chat. I'm going to respond once we're done here. I'm going to respond to every single person that chats. And that's my commitment to you. So feel free to use that. And we are up, off, and running. Let's go take a look at what the marketplace is doing right now. So, there's always kind of a theme or a story that's told in every one of these market updates. And right now, I think that one of the most interesting things to take a look at when you look at the current market dynamic is to actually go back and look at what was going on last fall, when 3 out of 4 buyers stopped searching. And the number one reason that they said that they were going to stop searching was 67% of them said rates were too high. Rates were too high. That was the reason. The second reason, of course, being that there was just no homes in their price range. Prices were too high as well. So when we look at these two things, number one is let's recognize that compared to then, our rates now are actually at a 2-year low. So mortgage rates. And it's always important to delineate which or to specify what rates are we talking about. It's mortgage rates, because the Fed funds rate is different. We'll talk about that later, but mortgage rates are at a 2-year low. Naturally, what that means is buyers will come back into the marketplace. For every 1% in rate drop, there's about 5 million more buyers nationally that enter the marketplace. And we have gone from 8% rates to about 6.5. So we're right above 6.5. Let's call it 6.7 just to be safe right now. Okay, so that is a big component of what's happening, is that of these 76% of buyers who stopped their search, a number of them are now returning to the marketplace based on rates being at the lowest place that they've been. The chief economist here over at Realtor.com said home shoppers who persist could see better conditions in the second half of the year, which tends to be somewhat less competitive seasonally and might be even more so since inventory is likely to reach 5-year highs. So there is a story of inventory rising right now, more options for buyers. So this is a good thing. We're in an interesting window where you have more inventory yet lower rates. And so right now, because here's the point. If you went out and asked a random person on the street, where are rates today? What are they going to say? They're going to say, hey, rates are high. Okay, cool. What they don't know is rates are at a 2-year low. So there's a window here in which we have more inventory. Now, on a national basis, it's gone up here to 3.7%, or excuse me, 3.7 months of inventory. We're going to look later here in the course of us being in this market update at where we are locally as well. You'll see that this is actually a local statistic, okay? And you see, you go back, see that we've gone from 2.9 to 3.2, 3.5, 3.7 months of inventory nationally. Well, locally, look at what's been going on. We were in this like 2,500 range, just sort of dipped in there, even this 26, but boom, boom, boom. It is rising. This is June, up to 3,948 homes or properties on the market, which is a huge jump from just a couple of months ago. So we do have more options available in San Diego County. Here's the trouble. Let me move I might have to be doing this as we go through today. I'm going to just jump up here to the top of your screen. Here's the trouble. Look at the pended properties. So while we've been getting more and more inventory, March to April to May to June, The homes that have gone under contract locally have been flat, right about 2,300 a month, every month for the last 3 months. So we are not selling more homes as a county, but we're listing more homes. So what that means is the absorption rate's getting worse. Buyers' negotiating power is at a really sweet spot, all while rates are a little, all right, not just a little bit lower. They've gone from 8 to 6 and 6.7. So at a 2-year low. So that's an interesting little window of opportunity that is available right now. Median price point right now, by the way, is right at $940,000 across San Diego County. So, we are rapidly approaching that $1 million mark. Now, this is a really interesting chart. I'm going to explain this to you. It measures buyer competition. So how much showing activity is there in the marketplace? You'd say, well, how do you know? How could you know? How is that measured? Well, on the real estate side, us real estate professionals, we have a tool that we use to do all of our scheduling. And it is the absolute dominant tool in the industry. It's called showing time. And in fact, you'll see down here, source is showing time right here under the green column. So showing time is the system that realtors use to actually schedule showings and make sure that it's all going according to what the seller said, the showing windows they're okay with, when there's an appointment, when there's not, et cetera. So showing time has the most data on how much activity is out in the marketplace as far as requested showings. Look at the 2021 number as it drops down. Again, this is the story. As I look at just the data, what's the story that starts to emerge? Well, it's one of increased opportunity for a buyer because there's less competition, lower rates, more available, while only the same amount being sold. So that's just kind of an interesting little window right there. Now, I'm adding this one in because this is a national statistic, okay? 1 in 3 homes are new construction. The reason I add this in is you might see something like this in the news. And the problem with the news often is going to be that, well, the news is not always exactly relevant to what's happening in San Diego County. While 1 in 3 homes nationally that are available coming to the marketplace are new construction, you and I know very well that on a local level, that is not true whatsoever. On the local level, there is not nearly the new construction that you have in places across the Midwest and in Texas and in Florida, and basically in the majority of the country. We certainly do not have that in San Diego. And I'm not talking about rural Midwest or rural Texas. Dallas, Houston, booming with new construction. But here we just don't have the space. We have Mexico to the south, the ocean. We have Camp Pendleton north of us, the desert, and you get it. You live here, so you understand what I mean. So point is, you have to take statistics like this with a real grain of salt. Now, this chart shows us home prices, and it really suggests that they're moderating right now. What you see is, and again, this is a national statistics. This comes from Case-Shiller. You see going back, this mark right here is 2023. You see there's 2 negative months, okay, going back all the way to January of 2022. And the negative months took place last year, April and May. But you see the flattening of the appreciation that you have year over year. So meaning measuring April this year versus April previous year. You see how it's really flattened out, and certainly looks nothing like that 2022 year whatsoever. So there's a little bit of a flattening of appreciation rates as well. And so maybe there's sellers that are thinking, if you really wanted to kind of reach that point, there's an interesting point here at which there's just a less acceleration. Now, it doesn't mean we don't have appreciation. Okay, we still have north of 5% appreciation, but we are certainly not in this silly money that was out there in the 2022 years and all that, with all of the stimulus money that was going around. What really strikes me here on a local level, this is a San Diego statistic, okay? San Diego statistic. This entire chart. I realize, by the way, it says national trend line there. That's because I could have added a national trend line to layer onto this. It's not there. Everything you're seeing is San Diego. This is homes with price reductions. Homes with price reductions. So, for example, in January 2024, this year, only 572 homes across our entire county reduced their price. But look what's been going on. From there all the way to this past June, there were 1,520 price reductions. Now, does that mean that there was a bad market? No. Could we, if we went back to the chart that shows us how many homes went pending? Could there have been more homes sold? Yes, but sellers have failed to understand that the buyer will not forever chase the money. It has to be substantiated, validated, and sellers are having to lower their price to meet the market where it's at. And the thing you can do is always remember there is no need to sit on the market for 30 to 60 days, 90 days. In fact, put yourself in the shoes of a buyer for a quick moment. Put your buying shoes on. $1 million home, you fell in love with it, you could afford it. It's hypothetical. Change it to whatever price range you want. And it's been on the market for 5 days. How are you negotiating? Where's your mind? How are you thinking? You just want to get the property. What do I need to do? But now same home, it's been on the market. I'm not even going to say 50 days. What if it's been on the market for 30 days? Suddenly as a buyer, you're thinking, okay, hold on a minute. It's been sitting here on the market for a little bit. Maybe I can get it lower. What can I offer? What's the lowest I can get it? What's the seller's paying? You start really getting into a buyer versus seller mentality as a buyer. So the longer on market, the more the sharks come out, so to speak. In fact, oftentimes a buyer will say to me, a seller will say, I'm not in a rush. And I say to them, that's great because I'm not in a rush either. Right? I'm going to be in business 6 months from now, a year from now, 10 years from now. So I'm not in a rush either. But once we go to the market, you have to understand that every single day on market is a day that you've proven to the marketplace that you're not worth your asking price. And you have to be conscious of that and put your buyer shoes on to think about how your own mentality would change if you were negotiating on a home that had been sitting versus one that was fresh. San Diego County right now has price reductions. That means there's opportunity. There are sellers that need to get to where they're going. And this is a picture we simply have not seen. Look how steady this was going back to June of 23. 600, 700, 700, 500, price reductions, now suddenly 1,500. So they've basically tripled. Now, again, if you have any questions, you've just joined us, you have a question on anything, go to the chat. I answer 100% of the questions myself, and that's my commitment to you. So make sure you do that. So this is months of inventory of homes for sale. And this is just to show you kind of where we are today, again, nationally, but how people think of this. Now, traditionally, people think, look, if you have over 7 months or more inventory, it's a buyer's market. If there's under 6 months, it's a seller's market. And if we're in 6 months of inventory, it's kind of neutral. I'll tell you that my experience is a little bit different. I would tell you that about 0 to 4 months or so is a seller's market. 4 months to about 6 months is neutral. And above that, there is certainly a buyer's market. Okay, and I hope I didn't misspeak a moment ago. 0 to 4 months, sellers. 4 to 6, neutral. 6 and north is a buyer's market. What does months of inventory even mean? It just means that if we stop listing homes today at the current absorption rate, when would all the homes be gone? So this is the national look at it. And you'll see that we were in that Great Recession timeframe. It was way up there in the buyer's market. And you'll see that in that COVID timeframe. We were way down in the seller's market. And right now it's just it's still in that seller's market range, creeping toward neutral. Locally, you'll see the picture, which we have now spiked up to 1.5 months of inventory, but still it is not quite where, like, we see that inventory growth, but it is still low. So why do I share this with you? It means that if there's there's this entire picture I've been painting on why there's opportunity for a buyer right now with lower rates, with more available, with less getting sold, with price reductions. Having said that, sellers, do not worry, do not scare, because there's still only one. I mean, we are in a seller's market. It's just not as ridiculous as it once was. That's all. That's all it is. But when you think about the pricing on your property and what you have to gain, what you have to lose, I did this math here for you. So if you go to October 2023, 8% rate, let's say the home was $950,000 and your payment would have been $5,587. What's interesting is that same $950,000 home now being $1 million, maybe it's appreciated. I'm using a 6.5% rate. We're about 6.7, okay? So it's gonna be almost the same math, but let's say on current trend line, and we'll take a look in a moment at what the Federal Reserve is saying they're gonna do. Maybe let's just take a 6.5% rate, higher price, but the payment has dropped by literally $531, saving you $191,000 over the course of the loan. The buyer's doing better on a monthly payment basis, and ultimately what they end up paying in interest over the course of that loan. And the seller, well, you have the appreciation out of it. So it's just a cool win-win scenario. It could mean that more buyers are going to jump back into this marketplace, though, as rates continue to fall. I am not, by the way, predicting a plummet. I had somebody email me today asking, when will we see 4% rates? I said, first off, I don't know the future, just like I hope no one else does. But B, if I'm a betting person, I wouldn't be building my wealth plan based on when we're going to reach a 4% rate, because that could be in years. It could be never. It's simply not something that I am predicting. I do predict that rates are going to drop, and it's only because I'm reading the data that I'm going to read to you in a moment, but ever so slowly, ever so steadily. And certainly I do not predict that we're going to see 4% this year or even next year. And if we do, I think it's years away. So again, I'm not going to build my wealth plan based on a 4% rate or even a 5% rate. What I'm going to build my wealth plan on is, where can I find great assets at the right value that I can cash flow and let real estate do its job, let depreciation work for me on my taxes, let all of those advantages be present. We might have multiple offer scenarios as that happens. We're seeing a lot more of that as more buyers are coming into the marketplace now. Home prices will continue to rise moderately. I definitely think that's the case. It's going to be moderate, just like you saw on the chart. And waiting ultimately really means you could be losing out on those equity gains, because even though it's moderate, that's still a 5% gain. But remember, it's 5% on the value of the property. That you have to take that gain and divide it into your down payment, which was your investment. And all of a sudden, the returns are much more interesting than 5%. Housing market. This is from the senior macro economist at Zillow Home Loans. They say the housing market, like so many other markets, impossible to time. The best time for prospective buyers is when they find a home that they like, that means their family's current and foreseeable needs, and that they can afford. Again, the best time for prospective buyers when they find a home that they like, that meets their family's current and foreseeable needs, and that they can afford. So what's interesting here is, let's take a look at what the Federal Reserve is doing, because it has a lot to do with what we can afford, right? It affects rates. So right now, today, the Fed funds rate, this is what this is measuring. And when you're listening to the news and they talk about the Fed's raising rates, dropping rates, will they drop rates, all that goes on, all that talk, they're talking about the Fed funds rate. That's the rate at which the Federal Reserve lends to the banks, at which then they can lend to you, to me, and of course, there's a markup. But the Fed funds rate right now sits at 525 to 550 basis points. Okay, so think of that as like 5.25% to 5.5%. We'll just speak in terms of basis points. The Federal Reserve is meeting on July 31st. So whatever the math is on that, 6 days from now or so. They're meeting on July 31st, and the marketplace is predicting 93% of Wall Street and like big money, right? The people that really drive these markets, they're predicting that the Fed is going to stay put, that there will be no change. You see down here at the bottom, 525 to 550, 93% of the marketplace believes that is going to be the case. So what does that mean? It means that if rates stay put, we should see no shifts in the rate markets. Be all right. There will be no shock. If they cut rates, you're going to see big time movement. If they raise rates, you're going to see big time movement, because the market is so on the same page that they're going to stay put. But if we go look at the next meeting, remember right now the rate is at 525 to 550. The next meeting is September 18th. And now the marketplace has a 90% bet that they will be dropping rates by a quarter point rate drop to 500 to 525 basis points. That is September 18th. Watch for that. The biggest thing we could be watching, is there anything that the Federal Reserve says that changes that prediction? And the number one thing that's going to change that is inflation reports. Let me give you the two things. Inflation reports and employment report. You want the inflation report, CPI report, to come in low. You want the employment report, get ready for this one, to come in low. It's a sad thing, but the way the market works is that if employment is strong, it signals to the Federal Reserve that companies are hiring because there's a lot of demand. And if there's a lot of demand, prices are rising, and that will put pressure on inflation. At the end of the day, this remains an inflation story. But If the employment reports come in as predicted or worse, if the CPI reports come in as predicted or worse, we're going to see this land and we should see a change in September. And then when you look at the November meeting, the market is betting that there will be an additional quarter point drop, even though that's not as unanimous. That's 60% of the market betting on that, 33% betting that it will stay put just after that one rate cut. So what the truth is, we're going to see, we're going to find out. But I'm going to be absolutely the one that's going to keep you informed. And so you just stick with me and come back to this. I'm doing this on a quarterly basis. And I'll just leave you kind of with this understanding here. Most agents, they know what's happening. They know what's happening. But good agents understand what's happening. Great ones can explain it. They can explain it to you in context and terms that mean something to you for your specific situation. So how this all affects you, your home, your assets, your condos, your land, how does it affect your investments? Well, if you want to spend a couple of minutes, we have really advanced new technology. So all you do is you scan this, or you just go to SanDiegoHousingReport.com. We have new technology that literally keep you updated on a monthly basis. It will keep you updated even more often than on a monthly basis when there's a significant change of your value on your home. And if you see something, hey, this system doesn't know I did these upgrades or did that, did the other, can make the adjustments to reflect it so that then you have data that most people don't have. Yes, they can go get their Zestimate on Zillow or what have you, but this is not that. This is a much deeper level of understanding and tracking. So if you go to SanDiegoHousingReport.com, you'll get yours, or you could just scan that QR code and get there as well. And as always, you can send anything through in the chat. And Rose, I see you. You could see anything in the chat or send anything there. I'm going to respond to it. Or you got invited here. You also, of course, can go and just reply to any email that you've received from me, and I'll be sure to respond to you personally as well. I'm going to go ahead here and Rose, how are homes selling with the issue of wildfire insurance in California? For the most part, Rose, absolutely fine, okay? Like there's not a big change whatsoever, but there are homes that are in high hazard areas. Remember, there's the California Fair Plan. So there's fire insurance coverage for everybody. We're not seeing it get in the way of most anything. Where it does come into play in a very significant way is in the high end. So if you're in high fires, in a high fire hazard zone, and you have a property where the construction value is north of $3 million, and you have to cover the property for more than $3 million in construction, which I believe that's the threshold for the California Fair Plan, then that additional coverage is wildly expensive. I know personally of somebody that just did $70,000 for 1 year of fire and flood insurance. So that's where there's a huge effect. For everybody else, has it changed? Yes, but maybe instead of paying $2,500, you're paying $3,500. So it's not something that's that significant for most would-be homeowners, unless you're in the very high end in a high fire zone, a high fire hazard area. What would be a high fire hazard area? Example, an area like Rancho Santa Fe as an example with all those eucalyptus trees. And it's, so think of an area like that. There you are looking at pretty darn high insurance costs if the construction value, not the home value, but the construction value exceeds that threshold for the California Fair Plan. So with that, I will leave you. I'll check out. It's always my commitment to be in and out of these within 30 minutes. We're at 24 minutes now. So I'm hoping that you'll return and I can continue to keep you updated on any changing market conditions here in San Diego County. And if you're looking to make a smooth move to or within San Diego County, be more than happy to set up a Zoom call with you or a home visit. Or of course, you could text and email us. I will be back with you here and you know where to find me.